Trading around the $10.56 mark, Nokia OYJ, New York Stock Exchange, continues to defy the outdated mental models etched into retail investor consciousness. While financial media headlines and casual stock market discourse on platforms like Reddit and X still frame Nokia through the nostalgic prism of 1990s and 2000s feature phones, treating the company as a low-margin legacy relic of the past, institutional heavyweights are quietly pricing in a fundamentally different corporate reality. The market mispricing here is monumental. Retail participants are looking at a faded smartphone logo, while institutional smart money is accumulating shares based on an aggressive, mission-critical pivot into advanced optical networking, hyperscale data center interconnects, and the high-performance hardware backbone of the global artificial intelligence supercycle. The hidden structural reality that Wall Street's consensus algorithms and retail traders routinely miss lies in the brutal physics bottlenecks of modern AI training clusters. As mega-cap tech hyperscalers race to build out massive machine learning training environments featuring hundreds of thousands of advanced accelerators, copper cabling has hit an immovable wall. Electrical signals degrade rapidly over distance due to resistance and signal attenuation, meaning that within massive server farms, data transfer bottlenecks threaten to leave multi-billion-dollar GPU clusters sitting idle, starved for data. Overcoming this physical limitation requires an immediate transition to advanced optical communications, coherent pluggables, and high-capacity optical line systems. What the public perceives as a sleepy European telecommunications hardware vendor is actually one of a handful of indispensable technological gatekeepers possessing the intellectual property, photonic service engines, and multi-rail inline amplification systems required to weave disparate data centers into unified petabit-scale computational powerhouses. While retail traders chase high beta momentum names and get repeatedly shaken out by routine macroeconomic jitters, institutional accumulation in Nokia reflects a calculated bet on the underlying physical infrastructure that makes the entire AI revolution mathematically and logistically possible. Market dynamics and institutional positioning. Analyzing the day-to-day tape of Nokia reveals a masterclass in institutional accumulation masked by prolonged periods of low volatility consolidation. Trading volumes frequently contract during macro-driven risk-off phases, creating artificial price dips that flush out short-term retail speculators fixated on quarterly headline noise. Institutional heavyweights utilize these exact liquidity vacuums to build multi-million share positions quietly, absorbing supply without triggering explosive upward repricings that would alert the broader retail crowd. This stealth accumulation phase occurs against a backdrop of surging fundamental performance, highlighted by recent quarterly data showing net sales to AI and cloud customers doubling year over year, alongside massive order intake numbers that prove enterprise demand is structural rather than cyclical. The tug-of-war between institutional conviction and retail apathy creates an asymmetric risk-reward profile. Traditional retail sentiment remains anchored to conventional valuation metrics, fixating on headline price-to-earnings ratios without adjusting for the massive structural margin expansion driven by high-margin optical network deployments and software-defined automation. When macroeconomic jitters cause sudden index-wide pullbacks, retail algorithmic panic selling regularly provides institutional desks with clean entry points to reload inventory. This dynamic underscores a vital lesson for ambitious investors. Looking past short-term price noise and understanding the underlying order book mechanics is the only way to avoid getting washed out before the broader market wakes up to a company's true operational transformation. Before diving deeper into the operational mechanics, let us pause for a moment. How are you currently positioning your portfolio around the hardware infrastructure layer of the AI trade? Are you aggressively accumulating shares during institutional shakeouts, or are you sitting on the sidelines waiting for a deeper market pullback? Drop your thoughts in the comments below. Business model and historical context. To truly grasp Nokia's current trajectory, one must aggressively strip away the historical framing that ties the company to its defunct mobile device lineage. Divested of its consumer phone operations years ago, modern Nokia is an enterprise-grade network infrastructure titan operating across multiple high-barrier-to-entry segments. The company's core operations are anchored by network infrastructure, spanning IP networks, optical networks, and fixed networks, alongside mobile networks and Nokia Technologies, which manages one of the world's most formidable telecom and connectivity patent portfolios. Outdated historical framing views this business through the lens of slow-moving telecommunications carriers upgrading regional towers on sluggish multi-year CapEx cycles. The modern reality is inverted. Today, Nokia's primary growth engine is propelled by hyperscale cloud providers, enterprise campus networks, and telecommunications operators racing to deploy high-capacity optical interconnects to handle the torrential data flows demanded by generative AI models. In segments like optical networks and IP networks, Nokia has systematically out-engineered competitors by introducing ultra-dense photonic service engines, quantum-safe encryption architectures, and advanced coherent pluggables that dramatically reduce power consumption and spatial footprints inside space-constrained data center facilities. By shifting its revenue mix away from legacy hardware maintenance towards high-performance software-integrated networking solutions, Nokia has successfully insulated its margins from commoditization, transforming itself from a hardware vendor to an indispensable architect of the global digital economy. Future outlook, catalysts, and risks. Looking toward the multi-year horizon, Nokia's growth thesis is anchored by several powerful secular tailwinds and technological gatekeeper advantages. The most immediate catalyst is the advent of scale across networking, a specialized architectural requirement where AI clusters outgrow the physical power and space limits of a single building, forcing hyperscalers to interconnect multiple distributed data centers across regional power grids. Nokia's leadership in high-capacity optical line systems, multi-rail inline amplifiers, and 800ZR+ coherent modules positions Nokia as a primary beneficiary of this multi-billion-dollar build-out. Furthermore, ongoing commercial trials and deployments of AI RAN architectures in collaboration with major technology partners validate Nokia's software upgrade path towards 6G, promising exponential spectral efficiency gains and securing the company's competitive moat well into the next decade. However, prudent risk management requires acknowledging the headwinds and vulnerabilities inherent in this thesis. Supply chain constraints, particularly surrounding advanced optoelectronic components and specialized semiconductors, can create lumpiness in revenue conversion even as order intake numbers shatter records. Geopolitical fragmentation, trade restrictions, and shifting regulatory landscapes across international markets introduce friction for multinational equipment providers. Additionally, any unforeseen deceleration in capital expenditure commitments among mega-cap tech spenders could temporarily compress valuation multiples. Yet, when evaluated objectively, these risks are heavily counterbalanced by Nokia's robust balance sheet, disciplined cost restructuring execution, and a growing backlog of high-margin AI and cloud orders. For the disciplined investor willing to look past short-term price noise and media misunderstanding, Nokia represents a textbook case of a misunderstood enterprise, quietly laying the essential tracks for the next era of digital computing. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.